Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm here today with Sam Shuttleworth, who is a partner at PricewaterhouseCoopers and the author of PricewaterhouseCoopers' biannual report on the New Zealand banking sector called Banking Perspectives, with the nice title of Banks Return to Normal but Not As We Know It. Sam, now this is obviously, this covers the half year from last year, 2010 calendar year.
Yes.
But what did you find? What was your main theme? I mean, it's quite a nice title you've got on there.
Yeah, it's very interesting. You know, the results that have come through for the second half of the year, but also collectively for the 2010 financial year, are mirroring kind of the profits that were made pre-GFC. But interestingly, the composition has changed. You know, what we've seen in the last 6 months was interest income is actually increasing up by about $278 million. Offset by other income, which has decreased by $320 million. Now that's a completely different change to what was previously the case, but also of importance is the bad debts have effectively halved, comparing the second half to the first year, but they've also halved completely when you compare 2010 to 2009.
And look, you've made the point a couple of points in your report about obviously last year in Australia was an election year. The banks copped it from the politicians and the media over their margins, and you have highlighted quite a significant increase in margins here in New Zealand. I mean, to what extent, how high are they? And do you think that we might see a bit of bank bashing slip into New Zealand's election year this year?
Yeah, it's important to note that we have seen the margins increase in the second half of the year. Now they're up about 8 basis points. That compares to Australia, which were roughly about up 5 basis points. But at an absolute level, New Zealand is still trailing Australia. And also, we should also take into consideration is that over the last 18 months, the net interest margin has decreased. So this is the first trend we've seen them actually ticking up. So the corrective actions that we've spoken about, the repricing of assets, the passing those costs, those higher funding costs on to the public and to the consumers, is starting to come through. Looking forward, we do expect, though, this net interest margin still to remain under pressure because international funding costs are still high, and they're likely to get higher when you take into consideration, I guess, the global demand for wholesale funding.
Yeah, what is your outlook for funding? I mean, I know this is a huge focus for our banks now, with the core funding ratio set by the Reserve Bank set to rise from 65 to 75% in the next couple of years.
Yeah, from what we can tell at the moment, all the banks are well positioned. However, you can't rest on your laurels. You need to carry on focusing. That's why we've seen the introduction of the covered bonds, another form of funding diversification coming through. So we expect those costs to increase because the global appetite, especially with Basel III coming along, all the banks are going to be competing in this area. From our retail deposits, we've seen good growth in retail deposits again, up $4 billion, similar to the first half of the year. But one thing we've noticed though is the premium above the OCR, that retail deposits, that's slightly compressed. So we may not have had this same intense war for deposits. I think the banks have got themselves a nice stable footing here, and now this is kind of refinements around the edges.
You also highlight that the 90-day past due assets are still at levels that are well elevated from where they were pre-GFC. I think 1.3 billion compared to 300 to 400 million. How long do you think it's going to take to actually get those back to pre-GFC levels? And how likely is it that the banks are still going to have to take another big hit from these overdue loans? Yeah,
look, very good question. What we've seen over the last 18 months is the 90-day past dues, but also impaired assets. Those assets where the banks foresee a loss will come, they have been growing. What we've just seen in the last 6 months, though, that growth has slowed right down. So what that means is hopefully we've seen the worst of the asset quality issues coming through. I caveat that with who knows what the economic environment going forward will bring, but that's slowed down. So the question now is how long will it take the banks to work themselves out of this position? If you're a mum and dad, you're 90 days behind and making your mortgage repayments, that's going to take a bit of time to catch up because your income growth doesn't increase that quickly. In respect of the impaired assets for, say, corporate New Zealand, well, you're in for the long haul with a bank because pre-GFC, the exit strategy for a bank could have been as, well, please seek refinancing elsewhere. That is not an option for these type of assets. So this could be a kind of a trend which will take a while to work their way out of the books. That said, the provisioning levels should be appropriate based on the information to date. So it will take, I guess, further deterioration to see any provisioning levels increase.
But in terms of getting down these past due assets past due loans. Do we need to see an a stronger economic recovery? Are we talking now of a double-dip recession? So, or do we need to see asset prices increasing again? What do we really?
Yeah, well, I guess you're looking at the residential mortgages. What would favour that? I guess growth in the underlying assets, further house price growth, or I guess wage inflation. But it will be a while to work their way through.
Look, you also highlight what you term economic overlays on provisioning, which have a retrospective element. That sounded quite interesting to me. Can you just elaborate on exactly what that means and whether that's perhaps making things look a little bit better than they really are?
Yeah, okay. So the banks provide for their books in two bases, kind of a collective provision and a specific provision. Now, the economic overlays are over these collective provisions. Now, the collective provision is calculated based on historical loss rates, loss factors. Debts that have gone bad in the past, they can analyse those statistics and then forecast what that means for the current book. What we've found, especially with the GFC, is because some of this loss data was through the benign credit time, they had to actually tweak the numbers, put an overlay over it because the economic environment currently of today was different to when those losses occurred. So they've adjusted those economic overlays to appropriately provide for the economic conditions. Looking forward, what will happen? Well, as long as the economy doesn't weaken to worse than what we've currently been through, those economic overlays should be appropriate. As the economy improves, you'll find them winding back these economic overlays and see a bit of provisioning release. What will make them adjust higher would be, of course, if the economic environment actually worsens to what we've currently been through in the last 2 years.
And look, you also note, I guess, anemic lending growth would be one way of describing it, 0.7% for the first half of the year. Where do you see that tracking, I guess, through both the second half of the 2010 to 11 financial year for the banks and the 2011 calendar year?
Look, we're not holding much hope for massive economic growth coming through in the lending book. What drives growth? Oh, business confidence, GDP, those type of factors. All early indicators are that this is still going to be quite a tough year, and so we don't foresee any major systems growth. What you may see, though, is a wee bit of positioning by the banks looking to take market share off each other. Now, I don't foresee that being an all-out pricing war, similar to what we saw in the retail market a couple of years ago, but it may mean that for certain customers, banks may be happy to kind of fight for their business and see a bit of isolated price movement.
Yeah, look, that was going to be my next question, was in terms of whether you expected a real competitive ding-dong among the banks in certain markets. Obviously, if you look at their asset bases, most of them aren't growing, perhaps even shrinking in some cases. So in terms of growing their total assets at the moment, is taking market share off their rivals the only way to do it? And how aggressive do you think they might be? And also what markets might be the ones where we see some action?
I think so. Generally, the economic environment doesn't indicate there's going to be massive growth in their books. So what are the two markets? Well, the retail market, a few of the campaigns 2 or 3 years ago, that was very cutthroat. You've seen recently, again, further indications at certain price points in the fixed rate curve where they're targeting. Again, what's happened recently is completely different to what happened 2 to 3 years ago.
Are you talking mostly about the mortgage market here?
Yeah, so I think there'll be small kind of pricing campaigns for a short period of time to get the consumers across. And also one thing to note of interest is the floating rate mortgages now make up roughly about 40% of the book. Back to about 2007, that was circa 14%. So that is an interesting event that's occurred over the last 2 years. But in respect of the corporate market, I think what you'd find with the banks is they'll be selective and they'll target very good quality customers. So if you're a high quality corporate, you're refinancing, you can expect some good pricing on those advances, those facilities, because you're a top quality customer.
Well, thanks for that, Sam. That's Sam Shuttleworth, partner at PricewaterhouseCoopers, talking about banking perspectives, PwC's twice a year report on the New Zealand banking sector. And I'm Gareth Vaughan from interest.co.nz.